Welcome to Chapter 16, Business Cycles of AP Economics Structured Independent Study. Chapter 16 is a complementary chapter to Chapter 15, in which we looked at measurements of economic performance. Here in Chapter 16, we put descriptions on the economic conditions that those measurements tell us about. So let's get started. Specifically, in this chapter, we will be looking at the phases and characteristics of the business cycle, and also the factors that affect the business cycle. So let's start with considering the phases and characteristics. And as we traditionally do, let's start with some simple definitions to build a foundation on. And we'll start with the term business cycle itself. The business cycle is a period of macroeconomic expansion followed by a period of macroeconomic contraction. And business cycles must reflect major changes in the real GDP calculation above or below normal levels. The business cycle has 4 phases to it, and they're very distinct phases. Here's the first one. It's called the expansion phase. It's a period of economic growth as measured by a rise in real GDP over that period. Economic growth, therefore, is defined as a steady, long-term increase in the real GDP. Now, your economy during an expansion phase will have 3 characteristics to it. Here's the first. Unemployment will be low. Incomes will also be rising. And businesses will be prosperous. Eventually, the expansion phase of the business cycle will begin to taper off, and that's when real GDP stops rising. And it leads us to the second phase of the cycle that we call the peak. And once we reach the peak, we'll start to see a contraction of the economy. And this is when the real GDP begins a marked fall. And the falling output generally causes unemployment to start to rise. Now, this third phase of the business cycle, the contraction phase, has 4 characteristics to it. Sometimes it takes on the profile of what we call a recession. And a recession characteristic of the contraction phase is when real GDP falls for 2 consecutive quarters, 2 consecutive 3-month periods. And a recession characteristic of a contraction has 2 characteristics within itself. The first characteristic of a recession is that it usually results in a prolonged economic slowdown, usually lasting between 16 to 18 months before we see a turnaround. And also during this period, unemployment typically rises to between 6 and 10%. If it goes to 6%, it's usually 6 to 7%. It's usually considered a milder recession, and it goes up from there in terms of severity. The second type of contraction is a depression. And what a depression is a longer and deeper recession. And some characteristics of a depression is that a depression has higher levels of unemployment exceeding the 10% unemployment that we refer to in looking at a recession. And during a depression, there is very little factory output. That's one of the reasons we illustrated a depression type period last chapter, in chapter 15, where we're looking at measurements of economic performance with supply and demand curves being flattened out dramatically. Now, there are two other terms with regard to contractions that I want to make you aware of. The first one is stagflation. This is an economic condition when real GDP declines, we have a recessionary type environment, and it's combined, believe it or not, with a rise in price levels, meaning inflation. This is a very, very debilitating condition for an economy that is extremely difficult to break. And it doesn't happen all too often, but when it does, it makes for really tough times. We'll be looking at how things are affected when stagflation sets in a number of different ways. We'll be looking at it graphically in upcoming chapters and in our workshops in terms of illustrating this type of economic condition, and also in our video studies, the periods of stagflation that we've seen in our economy in the past have been illustrated very clearly. The next term that I'd want to make you familiar with is just like when we reach the end of an expansion period, we've reached a peak in terms of the business cycle. The bottom of the business cycle that comes about as we reach the end of the contraction period is called a trough. When the economy has bottomed out, when real GDP stops falling, and we're getting ready to make a turnaround and go back into a expansionary mode. After some additional thought, I think I'll pause here for a second and take a moment to give you an example of stagflation. It's probably a good thing to do. And I'm going to lay out for you the economic conditions that must exist for a stagflation environment to develop and take hold. And to illustrate our example, I'll be talking about the period of time in the United States where stagflation set in between the middle 1960s all the way through the 1970s, a very difficult period of in our economy. And let me start with the first condition that needs to exist, which is there's too much government spending going on, which leads to rather large deficits and a mounting debt. And during the period of the 1960s and 70s, two major things happened that led to this government spending and the increase in deficits and debts. One was the money that was spent on President Johnson's implementation of his Great Society programs, the establishment of Medicare, Medicaid, and a whole host of other social programs that really increased the government spending. At the same time, trying to pay for the long war in Vietnam also contributed to the deficits and the debt. Now, when the government is seeking money, particularly money it doesn't have, which is why you have the deficit and debt situation occurring, it's looking to obtain money, and it's doing it by borrowing. And there's, with a limited amount of money available, it starts to compete with business interests for borrowing of money. Businesses look to borrow money to invest to try to grow and expand their businesses. But when the government is the 8,000-pound gorilla in the room and is borrowing heavily, it has a tendency to crowd out businesses from the credit markets, and this concept of crowding out is a topic that we'll look at in further depth both in chapters 18 and 19 and the effects that it has on an economy, and that's what occurred here. The second condition that set in addition to trying to borrow money to fund the government spending, the government also raised taxes, and we know what happens when taxes get raised. It has a negative effect on consumer consumption and a negative effect on business investment. Both consumers and businesses pull back because the cost of living goes up and the cost of doing business goes up as a result of the taxes going up. The next thing that happens is because there is such a demand for money in the credit markets, driven by the government in particular, it raises interest rates. When demand goes up, the price will go up. The price, the cost of money, the cost of borrowing money, follows along with that. The next thing that happens is that unemployment starts to rise. And why is this? For a couple of reasons, or well, let's put it this way, the most primary reason, as the cost of business keeps going up, businesses can no longer afford to hire or invest in hiring the same number of people to expand and maintain their businesses. They'll look to cut costs, and one of the biggest expense factors is labor, and you will see a rise in the unemployment rate occurring. Now, something else fuels the unemployment rate rising that is needed to fill out the conditions for a stagflation environment is that you have occur supply shocks. Now, a number of supply shocks in a couple of areas happened during the period between the mid-60s and through the 1970s, but the most notable of which was the supply shock to the petroleum markets, creating an oil shortage, and the price of oil went up. And this was a result of the couple of wars in the Middle East that occurred, and also some of the actions by OPEC in terms of trying to punish the West's support of Israel by cutting back and putting embargoes in place on the supply of oil. We had quite a mess, quite frankly. And with that driving up the price of oil, and oil is and gasoline is such an integral part of our economy, it again raised the cost of doing business, and that helped to fuel the unemployment rate. So we have the cost of business increasing more than demand. As a matter of fact, demand is going in the opposite direction. And we can really simply illustrate this using our aggregate supply and aggregate demand graph. As business is contracting here in this type of an environment, there is less that's produced, and the price level is increasing. So those are your conditions that need to exist for a stagflation environment. It's a very debilitating environment and tough to correct. And now jumping back to complete our 4 phases of the business cycle, the 4th phase is the recovery phase. And this is where I mentioned a few moments ago, coming out of the trough where the economy bottoms out, we start to move back towards an expansion. But as we do that, this is called the recovery phase. It's the period when real GDP begins to rise, and we usually define the recovery phase for at least 2 quarters to 6 months when it starts to rise again. In the study of economics, we have a very simple chart that we traditionally use to illustrate the business cycle. And here it is. On our x-axis, we are looking at evaluation over time, and on the y, GDP growth. And we use a 45-degree angle curve here to represent the consistent long-term trend of real GDP. And then we overlay on this curve another curve that represents the business cycles. And here's what the illustration looks like. It's a simple curve that we break down into component parts. For example, the expansion phase is at the front end. This is where real GDP is rising over a period of time. And as we mentioned earlier, when that begins to taper off, we call that phase of the business cycle the peak. And as we reach the peak, we then start a cycle of contraction. This is where for 2 consecutive quarters, real GDP starts to decline. And when it extends beyond the 2 quarters, we have a period that we consider a recession, usually lasting between 6 to 18 months generally. Now, obviously, if we were to illustrate a depression, in this case with this curve, the curve at the bottom here would start to taper out and stretch out to the right, because a depression is a prolonged recession and deeper recession. But we won't add in the depression illustration here. We know that at the bottom of a recession or a depression for that matter, when the economy bottoms out, it's called the trough. And then once GDP starts to rise back up and grow, we have a period of recovery, and then that will eventually move into a cycle of expansion. So here's the outlay of the business cycles. You'll want to keep this in mind because I'm sure you'll see it at some point on one of the assessments, if not the actual AP exam. Let's move on now to consider the factors that will affect the business cycle. And I don't think you'll find too many surprises here, is that in summary, these factors are the same things that have an impact on the economic measurements that we looked at in Chapter 15. So let's get started. This is pretty simple, and it really boils down to four main factors that have an effect on the business cycle. The first is business investment. Drops in overall business spending reduces output and income, usually across multiple sectors of the economy. And when that happens, that can start the spiral into a contraction. Interest rates and credit also have a tremendous impact on affecting the business cycle, both from a consumption standpoint and an investment standpoint. And the way that works, as we know, is low rates encourage business investment, will lead to increased output and the creation of new jobs, while the other side of it, high interest rates, will wind up leading to less investment, less money being borrowed to expand businesses, will slow down or lower output, and will also lead to some job losses. The third factor that can have an effect on the business cycle is consumer expectations. This can be very powerful. If the consumers have a negative outlook towards where the economy is going because they're anticipating potential layoffs and their incomes being reduced, what they will do is they'll start to cut back on consumption. And as that type of sentiment spreads, it can lead to a self-fulfilling prophecy in helping bring on a contraction. Now, the opposite is also true, that if the consumers in total have a more favorable outlook as to where the economy will be going over the next few months, if you will, for example, if they're anticipating finding a job or moving on to a new job that will pay a higher income, they're more likely to increase their consumption, and that will help bring on or fuel an expansion or a recovery for that matter. Periodically, about once a month, if you listen to the news, there'll be a story almost guaranteed on the measurement of consumer expectations in our economy in an effort to give you a feel for where this factor is coming into play regarding the business cycle. And the University of Michigan does its monthly consumer sentiment survey to measure just this type of thing, consumer expectations, because it has such a big impact on the business cycle. And they give you an update once a month as to whether the consumers in total are looking favorably or negatively towards where economic conditions are and where they're going over the next few months. And the fourth factor that can have an effect on the business cycle certainly doesn't need any lengthy explanation to it. It's external shocks, and they can either be negative or positive, and they're also very difficult to predict as to when and how they're going to happen. We'll include anything in this from wars to droughts and the like. The external shocks have a way to not only disrupt demand within an economy, but also the supply chain. So this then leads us to the question over whether the business cycle can be forecasted or predicted. And to a certain degree it can, however it's difficult to do. And the reason it's difficult to do is that there are some factors that affect the business cycle that obviously can be measured fairly easy and on a regular basis, but then there are some that are completely unpredictable. For example, the external shocks that I had mentioned a moment ago. But for the items that are measurable and we can keep an eye on, there's an organization that's an independent association, sort of like a consulting organization that the finance industry and businesses look to. It's called the Conference Board. And they look at the measurable items and they package it together in what they call the leading economic indicators. And these are a whole series of measurements that they're looking at, a lot of which you would probably be able to guess pretty easily as to what they include. Things like the performance of the stock market and what it's doing, where interest rates are at, and even things like manufacturers' new orders on a regular basis, particularly orders for capital goods. They publish this on a monthly basis, and it gives us, for the items that can be observed and measurable, somewhat of an idea of where the economy is going. As we move to wrap up this short chapter on business cycles, I want to add in two additional special macroeconomic measurements, the first of which is very important. So let's take a look. The first of the two measurements I'm going to talk about is by far the most important of the two. And that first measurement is one that shows a relationship between the inflation and the unemployment rates. The name of that measurement is called the Phillips curve. And here's your working definition for the Phillips curve. It's a curve that shows the possible combinations of the inflation rate and the unemployment rate. The relationship that it shows reflects an inverse relationship between those two measurements. Meaning, for example, it's generally expected that if the inflation rate is up, the unemployment rate will be down, and vice versa. If inflation is in check and it's down, the unemployment rate will be higher. And the reason generally for this is that if prices are going up or higher, assuming that businesses are profitable, they'll be able to hire more people because business conditions will be better. And the reverse is also true. If prices are down because of demand, and when prices are down and inflation is in check, businesses will not be able to expand because the demand isn't there, and they wind up trying to cut expenses. So the first thing they wind up cutting is the labor force, and that's why the unemployment rate rises. So this inverse relationship exists between the two generally. And we have a chart that we use to illustrate the Phillips curve, which we'll move to now and take a look at. Let me now illustrate a Phillips curve for you. And based upon where we have been in our studies, I have no doubt that you'll be able to thoroughly understand from a theoretical perspective what we're illustrating here. Now, when we illustrate a Phillips curve, we actually take two graphs and we put them together side by side to do the illustration. One of the graphs is a graph you're familiar with, is the short-run aggregate supply and aggregate demand curves. The other one shows the short and long-run Phillips curves. And with regard to these two charts, let's start with the one on the left, the one that you're very familiar with, which shows aggregate demand and short-run aggregate supply. And to start our illustration here, I have three curves for aggregate demand, one that shows the market equilibrium at a price level of 103, producing $10 trillion in GDP, let's say. And we have two other illustrations, one showing an increase in aggregate demand and the other a reduction in aggregate demand. Now let's introduce in the short and long run Phillips curves. But first let's label the Phillips curve graphs for you. Remember, we're comparing the inflation rate against the unemployment rate here in terms of a relationship. And on our graph we have the inflation rate represented on the y-axis, and we're showing an inflation rate from 0 to 3%, let's just say, for this illustration. And the unemployment rate indicated on the x-axis, and we're showing unemployment rate up to 6 to 6.5% from 0. Now, a short-run Phillips curve is a downward sloping curve from left to right, as you see illustrated here. And the long-run Phillips curve is very similar to our long-run aggregate supply curve. And here's the concept behind this. And you'll notice that it's at the 5% unemployment rate. The 5% unemployment rate is pretty much the full employment rate. Remember, as we've mentioned to you, that the government finds acceptable anywhere from 4 to 6% unemployment as being an acceptable level of unemployment in our economy. And with 5% being right smack in the middle, we consider that generally full employment. And over time, naturally, we fluctuate back and forth across that point, but on average, we're hoping that we will sustain over the long run generally a full employment type of picture. So we represent the long run Phillips curve as a vertical line here at the full employment rate. Now let's do some illustration. Here we have, back over on the short run aggregate supply and demand curve chart, the market equilibrium point at price level of 103, coinciding with a point that shows the short run and the long run Phillips curves at equilibrium. And I think that can make a lot of sense to you, okay? And that's a starting point for our illustration here. Now let's move to a condition where we have a reduction in aggregate demand. And over on our chart on the left, where we have our aggregate demand curve has shifted to the left. And we know a couple of things about that. If demand falls off, obviously the effect on prices and price levels, it's going to bring price levels down. And if we connect that to our Phillips curve graph, we see that at the lower demand levels, we have an increase in the unemployment rate and a decrease in the inflation rate. Well, why is that so? Here's the reason behind it. At lower demands, yes, prices will decline, but businesses will cut back on production because the demand isn't there. If they cut back on production, they're going to lay workers off, and that's going to increase the unemployment rate. Two things with regard to the increasing unemployment rate. What the impact that that's going to have on prices is because people can't afford to buy things, it's going to bring price levels down. And when price levels come down, as we see in both charts, the inflation rate will come down. Okay, so I think you can see a clear indication here as demand falls off, the unemployment rate's going to rise, and the resulting decline in the price level will bring the inflation rate down. Now, okay, what about the exact opposite? What happens when we have an increase in aggregate demand? Well, we have the opposite that happens. In an increase in demand, business conditions are generally considered to be good. And yes, that will increase prices because more demand will be running after less supply in the short term. But there will also, to match the demand levels, employers are going to hire more to produce more, and that's going to therefore reduce the unemployment rate. But notice we now have an inflation rate at 3%, and that's reflective of the increase in prices where you have more demand running after less supply in the short run, although the producers will eventually catch up to that. So we see here we have a inverse relationship. When the inflation rate is up, in the example I just gave you about the increased demand, where the inflation rate went up to 3%, the corresponding unemployment rate dropped. And the first example we looked at, where we have aggregate demand decreasing, the unemployment rate went up, but the inflation rate would drop. Well, we all know what happens next in the longer-term impact on our short-run aggregate demand and supply curves. Let's go back to the situation where we have the increase in aggregate demand. What's going to happen is the suppliers are going to meet that demand, and they're also going to wind up supplying more to a market. And when they do, it is going to lower the price level a little bit, as we see on our short-run ADAS curve. And that will have an impact on the employment. We're raising it a little bit. It'll bring down the inflation rate, as you see on our Phillips curve chart, but certainly not push unemployment even upwards in this illustration to near the full employment level of the long-run Phillips curve. So for many of you who are thinking about the opposite condition, what would happen with the decrease in aggregate demand obviously having an impact on suppliers and reducing short-run aggregate supply, we see the opposite condition occurring where our supply levels have shifted to the left. It has increased prices a bit, which increases the inflation rate slightly and reduces the unemployment rate slightly, but in that case not bringing it to the full employment level. So this is our illustration of that inverse relationship between the inflation rate and the unemployment rate. The second measurement I'd like to talk about is also an inverse relationship that's a little more abstract, and I just want to make you aware of it in case you run into it at some time. It's called Okun's Law. And here's what Okun's Law states, is that there's an inverse relationship between the change in the rate of unemployment and the difference between actual and potential real GDP. Now that's a mouthful, but let me try to explain to you how it works here. For every 1% by which the unemployment rate exceeds the natural rate of unemployment that we spoke about a few moments ago, that 5 to 6%, what happens is the real GDP is reduced by 2 to 3%. The difference then between the actual and potential GDP is called the GDP gap for an economy. Now, you're far more likely to run into Phillips curve questions than questions with regard to Okun's Law, but I did want to make you aware of this law just in case you're asked about it. Now, there's a few things with regard to Okun's Law that considerations and cautions that make it not looked at all that often, but again, just wanted to make you aware of it. And here are the cautions and considerations with regard to using Okun's Law. First, the law is approximate because other factors have an effect on output and the rate of GDP growth or decrease. And some of those factors are things like worker productivity. The second factor that can come into play in making the law approximate is that the amount of discouraged workers in the economy is not taken into account and can have an effect on this. And finally, cutting of workers' hours is not figured into it. Rather than just laying workers off and increasing the unemployment rate, the reduction in the number of hours that a worker works is not calculated into this because we're looking at the unemployment rate here. All right, enough on Okun's Law. This brings us to an end to Chapter 16. We'll look forward to seeing you in Chapter 17, where we look at taxation and government revenue.